Hi, this is Jeffrey Kleintop, Chief Market Strategist for LPL Financial, with our outlook for 2014 entitled The Investor's Almanac. A farming almanac is an annual publication containing a guide for the coming year and a forecast of the times and statistics of events and phenomena important to growing. Farmers' almanacs have been a source of wisdom for American growers for over 200 years, rooted in the core values of independence and simple living. In the LPL Financial Research Investor's Almanac for 2014, we seek to provide a trusted guide to the coming year, filled with a wealth of wisdom for investors. In 2014, LPL Financial Research believes portfolios are likely to enjoy more independence from policymakers than in 2013, when the markets and media seem to obsess over policymakers' actions both here and abroad. In the year ahead, investors can return to the basics of growing and preserving their portfolios and spend less time gauging the actions of policymakers for a few reasons. First, after two clean lifts to the debt ceiling since 2011, we're unlikely to see a high-stakes fiscal battle in 2014. Second, the Fed began to taper its bond purchase program, known as quantitative easing or QE, in the first half of 2014. Signaling a commitment to reducing its presence in the markets and transitioning to a post-QE environment. Finally, Europe is emerging from recession, which means less need for direct life support from the European Central Bank or painfully austere fiscal policy as deficit targets are eased. The economy and markets becoming more independent of policymakers while growth accelerates is likely to bolster investor confidence in the reliability and sustainability of the investing environment. The key components of LPL Financial Research's 2014 outlook include better economic growth, a flat bond market, and a double-digit stock market gain. U.S. economic growth may accelerate to about 3% in 2014 after 3 years of steady but sluggish 2% growth. Our above-consensus annual forecast is based upon many of the drags of 2013 fading, including U.S. tax increases and spending cuts, the European recession, and growth accelerating from additional hiring and capital spending by businesses. After all, in the past 3 years, weakness in government spending subtracted about 0.5% each year from gross domestic product. Just adding that 0.5% back to GDP in 2014 would, by itself, make a material difference in achieving 3% growth next year. Better economic growth may mean bond market total returns could likely be flat, as yields rise with the 10-year Treasury yield ending the year at 3.25 to 3.75%. Our view for yields to rise beyond what the futures market's priced in warns of the risk in longer maturity bonds and our preference for short-term and credit-oriented sectors of the bond market. High-yield bonds and bank loans are two sectors that have historically proven resilient and often produce gains during periods of rising interest rates. In 2013, both sectors were among the leaders of the bond sector performance during a year of higher interest rates. Historically, longer-term bond yields have tended to track the change in GDP growth when unleashed from Federal Reserve actions. Our expectation for a 1% acceleration in U.S. GDP over the pace of 2013 suggests a similar move for the bond market. While the bond market may be flat, we see better growth leading to stock market total returns that could likely be in the low double digits. This gain is derived from earnings per share for S&P 500 companies growing 5 to 10%, plus a 0 to 5% contribution from a rise in the price-to-earnings ratio. The rise in this ratio is due to increased confidence in improved growth, allowing the ratio to slowly move toward the higher levels that mark the end of every bull market since World War II. As 2014 gets underway, the 1, 3, and 5-year trailing annualized returns may all be in full bloom and be in the double digits for the first time this business cycle. Our analysis of history shows that it's the 5-year return that individual investors tend to chase, based on net inflows to U.S. stock funds. and this may prompt many investors to reconsider the role of stocks in their portfolios, especially as interest rates rise and bond performance lags. In 2014, there may be more all-time highs seen in the stock market and higher yields in the bond market than we've seen in years as economic growth accelerates. The primary risk to our outlook is that better growth in the economy and profits does not develop. That risk is likely to be much more significant than the distractions posed by Fed tapering and midterm elections. We believe it will be safe in 2014 to again tune out much of the antics in Washington, D.C., as the midterm elections turn up the volume, but not the impact. In the near term, Washington may be washed up when it comes to driving the markets. We at LPL Financial Research welcome a return to the basics of growing and preserving portfolios in the year ahead and the opportunity to serve as a trusted partner to you and your advisor. Thank you for watching. For more information, ask your advisor for our detailed white paper entitled Outlook 2014, The Investor's Almanac.